Welcome back to the second part of our today's lecture. Now let's just shortly turn to model risk as a slightly different type of risk we want to talk about here in this class. Now, model risk can be understood as a type of a generalization of the actuarial risk, since with actuarial risk you're concerned about an inaccurate modeling of possible claims, of possible losses, and it's quite similar to model risk. One central task we have to deal with in financial risk management is to accurately forecast future losses. And if we choose the wrong model, and if we do an inaccurate type of modeling, we could face losses, not simply because we have entered such risky contracts, but simply because risk management itself was flawed. And because of this inadequate risk modeling, we will face losses, and these losses are due to model risk. Now, it could, for example, be that a risk manager simply has chosen a model that is fundamentally unsuitable for estimating losses. So it's a completely wrong model. Even if the model is well suited, might still be that the risk manager, him or herself, is not able to correctly use the otherwise correct model. So it's the correct model, but an incorrect use of a correct model. And even if he uses the right model in a right way, it could simply, in the end, be that he uses a wrong set of data. So there are data errors, estimation is done in a wrong way, and again, the quality of risk assessment will be impaired. This is model risk. It's the risk that a company suffers a financial loss from the use of a model that shortens reality or the incorrect calibration, estimation, or use of a model. Now, actually, a model always shortens reality. That's the very definition of a model. But it might be that a model is too simplistic. Might be that the model should be more complex in order to accurately model reality, and it could be that the model itself is suitable, but it's wrongly calibrated, it uses the wrong set of data, and the effect is that you're facing financial losses. The following types of risks can be distinguished when it comes to model risk. First one is use the wrong model. So the model has a different purpose, it is generally unsuitable for the intended purpose, or the model is incorrectly specified. If the model is correct, it could be that it's incorrectly implemented. A very simple source of model risk is a programming error. If you have a programming error in your computer code, you wouldn't expect the risk forecast to be accurate. There could be technical errors, two-cause approximations. For example, in a very simple case, if you assume a linear relation between two variables, but actually in reality there's a non-linear relation between two variables. Or you could use the model in a wrong way. For example, you have data problems, you have over or underfitting, you have an incorrect model specification, incorrect model calibration, and in the end you overinterpret the results. You have correct results, but you simply interpret these results in a way the results were not intended to be. In some case, you realize that your model is capable of something or it's not capable of something. These are model risks. Now, which examples of models can you think of where model risks can arise? Do you have any examples? Yes, slightly different. What's slightly different? The Black-Scholes-Merton model for option pricing is a prime example of a model that can pose model risk, because the fundamental assumption in the Black-Scholes-Merton model is that the underlying follows a Brownian motion or geometric Brownian motion, that is a diffusion process, stochastic diffusion process. You said that actually the underlying is normally distributed. Log normal, yeah. one has to be careful about that. It's not actually assumption, it's the result of the assumption of a Brownian motion or geometric Brownian motion. Now, it's a pet peeve of mine, I have to say, that, but one has to be careful because usually people from management studies and business administration will shorten the ingredient in the model by saying returns are normally or prices are log normally distributed. Actually, the assumption that is made is of a random walk of a geometric Brownian motion for the underlying. And as a result, if you assume prices or returns to follow a geometric Brownian or Brownian motion, the result is that you will have a normal distribution. But it's not simply the assumption of a normal distribution or log normal distribution. But yes, if this is not correct, and this is a simplification, that, for example, stock returns are normally distributed, then of course the model will be off. You know? Same with any asset pricing model. If you assume any asset pricing model for the stock returns or bond returns, and if you have false assumptions, unrealistic assumptions, you will have model risk. You had a different example.
Yeah, isn't the most basic example the market model of the ideal market without imperfections?
The market model, you mean also in asset pricing?
For example?
Yes. I mean, also the capital asset pricing model is also an oversimplification. It has some rather unrealistic assumptions. Efficient market hypothesis, the idea of an efficient market is also a model that might be too unrealistic. And in essence, any pricing model for any financial asset usually will pose some kind and some degree of model risk, because you will never be able to establish the process that in reality drives asset prices. It will always remain a model, and then you will always have a model risk. And this is, this is quite interesting. There is a colleague at the London School of Economics, John Danielson, who has written some papers on model risk. And one paper is, I think, called The Model Risk of Risk Models. And he also, I think, relates model risk to what he calls endogenous risk. And this is something that is also quite interesting. At some points it gets a little bit too philosophical for my taste. But still, endogenous risk, and he gives a very good example for endogenous risk. Do you know the Millennium Bridge in London? It's a pedestrian bridge across the River Thames. It's a very famous pedestrian bridge they built for the Millennium. I think the name is called the Millennium Bridge. The interesting thing about the Millennium Bridge is that, in fact, if people walk, and they had to rebuild it in some part of it, I think, and renovate it, it's a bridge, and if you walk across it, there is a slight vibration in the bridge caused by people walking across the bridge. But when the bridge opened, people started to walk across the bridge, and when they felt the vibration and the movement of the bridge, they immediately starting to counter those movements, and by doing so, and because all the people on the bridge were countering the vibrations of the bridge, they actually strengthened them, and suddenly the bridge became unstable. And this is what he refers to as endogenous risk, because by trying to decrease the risk, and by trying in a different sense to hedge against those risks, you are actually enforcing and enlarging and strengthening these risks. And this is the same, I guess, with model risk. If you, and this is quite interesting, there are some papers that show that actually every time regulators demand institutions, financial institutions, to install a certain type of risk model, like, for example, value at risk modeling, this means that it could also backfire, because suddenly all the companies, all the financial institutions are moving into the same direction, and this could backfire from a systemic point of view. And this is quite interesting. But coming back to our basic problem here and basic question here, of course, all pricing models are prime examples for model risk. If you use any pricing model, for example, for stock prices, bond prices, derivatives, credit derivatives, you will always have model risk. And this simply means that if you use the wrong model, if you make the wrong assumptions, garbage in, garbage out, wrong data, your model will have erroneous results as output. Okay. Some sources: wrong pricing model, inaccurate estimation of market indexes, forecasting period is too long, simplifying assumptions, data errors, general overstraining of models, and excessive complexity of certain tasks. For example, if you want to model and to forecast tail events, if you want to determine systemically relevant financial institutions, at some point you're just asking too much of a model. You can of course try to forecast tomorrow's lottery numbers, but no risk model will be able to do so. Data errors is, I think, quite interesting, because in many applied sciences you'd have data errors. If you go to engineering, if you go to construction, you can simply look at the ceiling, for example, here, and you could see little cracks, and you can say, okay, if you want to measure the resilience of the material, if you want to measure the size of the cracks, you will have data errors, because there is no such thing as completely perfect, accurate measurement. But at least in most economic applications, you will have accurate measurements. You will have no data errors when it comes to the measurement of a stock price. A stock price is 20 euros and 50 cents, and it's not 50.00529 cents. So as all prices are usually discrete, there will not be any measurement errors. But there are few instances in which we might have data errors. And that is, for example, in high-frequency data. In high-frequency trading, if you are looking at prices at, for example, 1 second or 5 second intervals, you might have some data errors. And in the tutorial to this course, I have one paper that actually looks at some data errors. And there is one other example. For example, if you go to Thomson Reuters Financial Data Stream, they round prices to some degree. And then you have slight data errors. But I would assume that these data errors don't matter. You know, they round prices to cent, to 1 cent multiples, but I don't think that these data errors matter. Okay. Some approaches for limiting model risk. First of all, you can use multiple models. By using multiple models and by interpreting the differences that different models put out, you might be able to find the worst case, the best case scenario. You can try to simply average the results of multiple models. And there are some interesting things you can do here. But the basic idea is just trial and error, try out many models and see what comes out of it. You can try to quantify model risk using a benchmark. For example, if you take the Black-Scholes-Merton model as a benchmark, and you can compare the results of the model with actual prices, you can use this as a benchmark and then try out other more sophisticated models. You can consider limiting cases. You can look at extreme scenarios. You can review the model assumptions. Also, it is always a good strategy to try to use parsimonious models. What is a parsimonious model? Parsimony means that if there are several models to explain a phenomenon, the model with the least or most economical assumptions should be chosen. For example, in a time series model, you should try to do the best with the least and the smallest number of parameters. Why? Because if I want to model an economic concept, and I just say, okay, I use a model with 2,000 parameters, I can model everything. 2,000 parameters. It will be difficult not to be able to accurately model something with 2,000 parameters, but it's not a parsimonious way of doing things. So use as less parameters and least assumptions as possible. If the modeling is not accurate, you can try to use more flexible models and increase the number of parameters, but you should try to keep it simple. And last but not least, back and stress testing. Back testing is what? You take your model to the data, and you try to assess the accuracy of your modeling by comparing the model forecasts with actual returns, actual values. And you can then see, for example, that your model was actually quite good in forecasting the future. And then if your model is good in backtesting, you can leave it. If you find out that your model does not perform well in backtesting, you have to change the model. A simple idea is, if you, for example, somehow were able to come up with a model for tomorrow's lottery numbers, what would you do?
Maybe keep it a secret and use it for myself.
Yeah, of course. But first of all, before gambling, you would do what? You would try it out without any money. And what would you do? You would simply take your model, forecast tomorrow's lottery numbers, wait one day, and compare your model forecast with realized lottery results. And then at that point you would see, well, my model is actually working. If that were the case, you would use it. If that were not the case, you would make new assumptions, you would make adjustments to your model, and you would change the way you forecast those numbers. It's the same here, not just with the lottery, but with financial returns and financial values. You would use your model and you would backtest it with historical data. And if you just wait a day, I mean, this is historical data. Yeah? You have realized numbers, you have realized returns, and this is historical data. And then if this works, you're fine. If not, you have to change the model. And stress testing is somewhat related to this. In stress testing, you simply take your model and you look at extreme scenarios. What would happen if something was extreme? And in this very unrealistic example of a model for tomorrow's lottery numbers, what would you do in stress testing? You would simply assume that you buy 10 lottery tickets or 20 lottery tickets, and you would see how much money can you lose in an extreme scenario. And you would see the maximum amount of loss is, say, 1,000 euros. And if you are okay with that extreme scenario, then you're fine. In fact, stress testing can be differentiated into macro and micro stress tests. In micro stress testing, we'll talk about this later in the next chapter, but micro stress testing is more about a single company, a single firm, looking at extreme scenarios and what would happen to our company if, for example, all our customers left, if our supply chain collapsed, if our financing went up, if liquidity dried up. This is micro stress testing, and I would assume, and I would at least hope, that every entrepreneur has done some type of at least imaginary stress testing in his head, that if you open a restaurant, you would simply think about the scenario, what would happen if I don't earn a profit the next 3 months? And actually, this is the basic scenario for most small enterprises to go bankrupt within the first year, because they have no plan how to survive, even if business has gone down or is not taking up as quickly as imagined. If you open a business, you need to have a plan, what happens, and what would you do if the first 3 of the first 6 months are bad. This is stress testing, more or less. You are just imagining the worst case, and you try to come up with a plan what to do with your enterprise in case you are under extreme negative scenario. In macro stress testing, usually central banks, supervisors, regulators do the same, just with the whole economy or whole industry sector, usually in financial insurance, in the financial industry. For example, central banks will take the banking sector and they will look at a scenario in which All market parameters are quite bad for banks. Interest rates are low, unemployment goes up, markets deteriorate, and central banks will assess the danger to the whole banking sector by stressing the whole sector, the whole industry. This is a macro stress test. Okay. Yeah, I should have given you this, and I think I've talked about it. There's enough backtesting and stress testing, and again, there's a distinction between macro and a micro stress test. Okay, now enough about risk types. You now know that you have market risk, credit risk, op risk, liquidity risk, maybe actuarial risk, and model risk. Of course, model risk applies to all those types of risk. You can have a bad market risk model, credit risk model, operational risk model, and model risk can arise everywhere, anywhere. Now, next, we need to identify our risk sources. In many cases, this is quite simple. A very extreme example of a case in which you were not able to identify the risk source is again the Fukushima Daiichi case. In Fukushima, you had identified the earthquake as a risk source, but you were not able, and people were not able to identify the interplay between the earthquake causing a tsunami and its risk exposure of the power plant. Now you need to identify all elementary risk factors, all sources of risk. And next you will have to do a risk mapping. What is that? Well, we need some basic background in probability theory. Because this is, I think, quite interesting to see when you pick up a book on risk management that is written for math students and for statistics, in statistics. Now, what is a risk factor? An elementary and basic risk factor is nothing else than a random variable. And we start with our risk factors being random variables, and those random variables are defined on a probability space. You don't need to understand the full details and the mechanics of a probability space, but you need to know this when you pick up a book that is not trivial and that is a little bit heavier on the mathematics. Because all random variables are always defined on what we call a probability space. A probability space means that you have a actually, it's defined on the next slide. We'll talk about this later on. But you know random variables. And a random variable, for example, first of all, is we need to use a random variable for the value of an investment. We have, for example, an investment in a stock or a bond. And this stock investment, for example, has a value. So we need a random variable v at point s. S is a point in time. And of course, the value can change from one day to another. And since the value of this investment is random at a future time s, it's a random variable on this probability space. Now, what is a probability space? It's simply the mathematical framework for modeling probabilities and stochastic behavior and random experiments. It's a triple sigma, f, and p. In German, it's actually called sigma f script. You know, this way of writing f, some people call it f script. Okay. Now, what is sigma? Sigma is simply the sample space. So it's the set. It's not actually not an amount. It's a set of all elementary events. The simplest example of a probability space can be thought of with a rolling of a die. If you have dice and it's a regular die, you have 1, 2, 3, 4, 5, 6 in the empty set as elementary events. In German, same word, Elementarereignisse. F is a so-called sigma algebra. What is a sigma algebra? It's a set of elements on which you can define certain operations. So it's, first of all, a set of events. Same word in German, Ereignisse, and you might remember from your statistics introduction that events or Ereignisse are what? They are sets that include a number of elementary events. So for example, 1, 2 is an event. So start with these sets and so on, and also the empty set. And for example, if you have 1 and 2, and so on, 1, 3, and 5, and you go on, you get all the different events, all the Ereignisse. And if you now define certain operations on this set of events, then you get a so-called sigma algebra. In fact, a sigma algebra, it means that it's closed under the building of the complement and under countable unions and countable interactions. I'm not pretty sure whether these are the most accurate English translations. It simply means that if you take the intersection of two events, and if you take the union of two events, the result is also included in the sigma algebra in this set. And this is a sigma algebra. What does it mean? It simply means that you want to assign a probability not just to 1, 2, 3, 4, 5, and 6, but you also want to put a probability on, for example, an even number, an uneven number, numbers less than 3, numbers higher than 5, when you consider the rolling of a die. And the sigma algebra enables you to do this. So you can do proper calculations with probabilities on this set of events. And then, of course, P is a so-called probability measure on the sigma algebra, which is just a function that assigns probabilities to all those events. Not just to 1, 2, 3, 4, 5, and 6, but also to 1, 2, 1, 3, 1, 2, 3, 4, 5, 6, the empty set, and so on. And in many cases, any mathematical paper, any textbook that deals with these sorts of random variables starts with let x be a random variable on a probability set. Why do you do this? Because this is actually the basis for your mathematical and stochastical modeling. You have a probability space in real life. You don't know anything about this. It's unknown. It's latent. But you can observe certain processes in nature, and the probability space reveals itself by giving out results of random variables. It's a little bit theoretical, but think about this. When you take a die, actually you don't know the probabilities. You can only observe the results of certain experiments. And by doing enough experiments, you can get a distinct clue and a distinct idea of what the hidden probability space in nature looks like. But you don't know the actual probabilities, because if you knew those, this would no longer be stochastic. So this is the theoretical idea behind using a probability space in nature that reveals itself and its probabilistic behavior by showing you results of random variables defined on this probability space. Okay. Now you have a random variable, and you are not interested in the losses. No, you're no longer interested in the values, but you're actually interested in losses. So what is the loss from such an investment? It's actually the difference between the value at point S and the value of the investment at a later stage, V of S plus delta. Now that could be 1 day in the future, it could be 1 week or 1 month in the future, but of course The difference in the value is, first of all, a loss or a profit, and we take the negative of this difference. Why? Because, for example, if this is in S and this is tomorrow, S plus delta, we would have a profit of 1. But we want to model the losses, and I told you in the very first lecture, I think, that usually we neglect the profits, we only look at losses, and as it is quite uncomfortable for us to deal with negative numbers all the time. So if this is a profit, we are not interested in it. And if it's a loss, we simply leave out the negative sign and we change the sign, we switch it. And this is why we have the negative difference of Vs plus delta minus Vs. Now a loss will be a positive number, a profit will be a negative number, or we could also just set it to 0 because we are only interested in modeling losses. Okay. In time S plus delta, this loss is observable and no longer stochastic. At time S, however, the difference in the value is stochastic and the loss is random. So this is our loss distribution. L, S, from S to S plus delta is the loss distribution. And we refer to it, first of all, as the unconditional loss distribution. And the conditional loss distribution is actually the conditional distribution of L given a certain set of information known until S. It's a small difference, but it's an important one. Now, if you take, for example, data like this, you simply take this data, you calculate the mean and the standard deviation, and you use it in a normal distribution. This is an unconditional loss distribution. Why? Because you simply assume that the distribution doesn't change over time. You take historical data, but you estimate the parameters as if the parameters don't change over time. If, however, you are interested in a time-varying modeling, you have to use conditional parameters, conditional distributions. And have you seen conditional distributions in your math classes? I would pretty much assume so, right? Conditional distributions, conditional probabilities? No, okay. No, in statistics? No? Okay. But you probably know what a conditional mean is, right? And a conditional probability. In German, bedingte Wahrscheinlichkeit, bedingte Erwartungswert. Okay, small crash course. I need more space. Yeah, I have some space here. Now, a conditional probability of, say, you have A, sets A and B. What is the conditional probability of A given B? B is known. What is the probability of A given B? Divided by? Yeah, probability of B. Quite simple. You know, you can construct simple examples that show you that this is the conditional probability of A if B is known. Now, okay. But if you have conditional probabilities, you also have conditional distribution functions, conditional density functions, and you can construct and define, for example, the conditional distribution of x given y. You can have a look at the average of x. This is the conditional mean of x given y. And you can define all the things you know from your statistics class, not just for a regular unconditional distribution, but also for a conditional one. And this means that you are calculating probabilities with the additional knowledge that B is the case. And in many cases, this is additional information. And why do we need this here? At this point, this is, and this here, what I did here, this is an unconditional distribution. I simply take all the data, all the parameters, all the distributions are unconditional. And in financial mathematics, there is a very interesting way of coming up with an idea how to model things time-varyingly. And what do? You simply look at, for example, the distribution of, say, L, the losses under a certain set of information up until point T. And this is quite complicated. What you do is, you take all the information you have until time T. For example, all the historical market prices. You come up with a fancy way of including this information in your distribution, and then you look at the conditional distribution of LT given the information of, say, LT minus 1. So usually you write this in this point, which means that you look at the information up until point T minus 1, and you're interested in the distribution of the losses for the next day, for the next month, for the next year. And this is how you do conditional modeling, time-varying modeling. If you have heard, for example, a lecture on time series econometrics, or any class with Professor Süßmuth in econometrics, in financial econometrics, all those models are time-varying and they use conditional distributions. And in the end, it simply means that, for example, in modeling, you have time-varying parameters in many cases. You don't take all the data and simply estimate two parameters, but somehow you use the data and you estimate the parameters in a time-varying fashion. And then you get a conditional model. Here, at this point, this is just an unconditional loss distribution. And this is shown because we don't have a time index t here, and this is left out. So every time you hear time varying or conditional modeling, a conditional model of credit risk, this means it's time varying. Conditional means time varying in these applications. Okay. Now, yeah?
Question, like if you were to estimate, for example, the volatility and you have a given data set of, say, 30 days, and then we use this the data of these 30 days to estimate our volatility on the 31st day, would it be then that on the next day, so on our 32nd day, we would use data from the previous 31st days? Because then it would be like we would still incorporate all the data that we have to forecast against. So where's the difference?
This is purely an empirical question, and a question that is related to the estimation of the model. Now, in theory, you will come up with a model that includes a generic conditional distribution that is for example, the losses that are conditional on a set of information. And you would simply say it's conditional on the set of available information up until point t minus 1, for example. It's a totally different question how you estimate this model. And one way would be, for example, to use rolling windows. One way would be to use all the data and estimate the parameters in sample with a certain evolution function for the parameters. Some models do that. In many cases, you have to make an assumption for the very first value, the starting value. In time series econometrics, you usually have a regression analysis. And the way you use the data and the best way to come up with a good estimation of the parameters is solely a result of your empirical strategy, but not of theoretical modeling. In theory, the mathematics is always that you have a model and you simply assume that you have a conditional distribution of losses conditional on the available set of information. Now this would also mean, for example, you know everything in the economy, all the variables, all the state variables, which you will never include empirically in your estimation. What you would do is you will just use historical data of the variable in question. But theoretically, for the mathematician, it's always conditional distribution. And if you are interested in this, simply take a very simple model from time series analysis. In time series analysis, it's the same. You start, even if you have an autoregressive process of order 1, this is already a model that is time varying, and if you have, well, the process is time varying, the parameters are not, but actually this is a time varying conditional distribution. And this is interesting to remember because it means that if you ever see something like this, LT or XT with like this simply shows you that you do conditional modeling. And it's a totally different question how you empirically estimate this, but the idea is that all the information available is included in this set sigma t. Sometimes you also write it in this way. This, I think, makes more sense. What do you call a filtration? A filtration means that you have a staggered set of information sets that are increasing in nature, because every day you have more information available. And so this looks like a Russian, like in this Russian puppet toy that becomes larger and larger. And this is basically the same idea, but empirically it depends on how you estimate it. For example, in this case, I could just take this data, estimate the parameters here, and then I use this data, and then estimate mu t plus 1, sigma t plus 1, and so on, and then I have a set of parameters that changes. This is a not very correct, but a very easy and easy to understand way of including time variation in your modeling. But let's not get ahead of us. Let's stick with the unconditional distribution here for a minute. And again, this is what we usually refer to as the P&L, the profit and loss distribution. And if you are only interested in the losses, we simply take the loss distribution. Now, in many cases, we don't need an arbitrary time difference S to S plus delta. It suffices to simply look at changes from S to S plus 1. For example, today, tomorrow, tomorrow, the day after tomorrow. So the differences in time are equidistant, and we can simply look at the change from the value of the investment in T plus 1 in comparison to the value in T. This means that it is simply LT plus 1. The change in value from today to the next day, to tomorrow, or next month, or next year. S often refers to the number of years over which, for example, payments are made. Usually S is the number of days. In high frequency trading, it's probably the next 5 seconds, but we would then set, for example, a delta to be 1 over 365. And at this point, I usually want to remind you of something that is actually quite important in practice, but I have never seen any research article on this. This is day count conventions. In industry practice, it is actually quite important and imperative to know which day count convention you use when forming and when fixing prices and payments. Why? For example, with interest rates, you use actual. This means that the month and the year have the actual number of days, also the calendar year has. So if you are in a leap year, Schaltjahr, February has 29 days. Actual 365F is the actual number of days of the month, but each year has 365 days. This is not accurate, speaking from the point of view of the calendar, but it's a simplification to make payments and calculations more easier and easier. Actual 360, 30, 360 and 30E 360, those are all different types of day count conventions, and they set out rules for how many days a month has, how many days each and every year has, and on which days payments are made and payments are due. And if you don't make the payment, you are in default. So this is actually very important. And they also relate to the question on which date and then on which day payments are valued, and they are signed on to accounts. Those are business day conventions, the day count conventions. Those are quite important in practice. As I said, I think researchers don't really care about them because there is not. I fail to see the scientific value in looking in detail at day count conventions. Yep.
Now it's just remnants of former older times when there wasn't so digitalized, and
Probably.
are they still used today?
Yeah, of course.
Even the easier ones like 360.
Yeah, I would assume so, that all those are still used. They just make calculations of interest rates and payment dates easier in some trades, I guess. I would pretty much also assume that they date back to the times when computers weren't around. But those are still used today. Yeah. Now, coming back to our risk factors. We have to realize that losses don't fall from the sky, but those losses, the loss distribution LT plus 1, is the result of several elementary risk factors playing together and causing a loss on a financial position. Now, we have to assume and make the assumption that VT, the value of an investment, is actually what? It's a function in time and a set of random variables, random vector ZT of the elementary risk factors. What does this mean? Assume we have, for example, a stock investment. VT is the value of a stock investment. What elementary risk factors are there? What risk factors drive the time evolution of a stock price? Now, don't say the price, of course, but the price is VT. What drives the stock price? What could be an elementary risk factor for a stock price investment? A stock price. Yeah? Interest rate. Profitability. Equivalently, default probability. Yeah? Liquidity or what? Of the company. Profitability. Would also say maybe dividends. Overall stance of the economy. If the economy goes down, the market might also go down. Market risk. Markets return from the CAP, from the CAP-M. So we have a number of elementary risk factors that might be or might not be directly related to the company that can influence the stock price. So VT is a function in T and a set of D elementary risk factors. This function F should be can be any measurable function, and at this point we are not concerned about how F looks like. But we simply assume that it's a measurable function. Now, risk factors are usually observable at time t. We know what today's unemployment is, what today's market return is. And the choice of risk factors, on the other hand, is a modeling task and will vary accordingly for different investments and from investor to investor. Now, if I were to ask you to model a stock price, and you would say liquidity, you would say profitability, I would say dividends, each and every one of us would come up with a different risk model, a different pricing model. And in fact, this is what we call a risk mapping. It's a function that maps risk factors, elementary basic risk factors, to a financial loss. And this is the first task we have as a quantitative risk manager. We need to find a function, a risk mapping, that is able to explain changes in market prices, in values. Okay, so we will see some examples of mappings later on. And we have already talked about some elementary risk factors, some basic risk factors. Interest rates, unemployment rate, GDP growth rate, market return, default probabilities, yield rates, revenue growth, maybe even number of employees, and so on. So these are basic risk factors that can also be the same for a number of companies, but some of them will also be company specific. And then, if we know about elementary risk factors, now let's look at elementary risk mappings. Now, we've seen that the value of an investment depends on time t and the risk factors zt. Now we go back and remember that actually we are interested in losses that arise from a change in the value vt compared to the next day's or next year's value vt plus 1. We exchange zt minus zt minus 1. We set it by xt, which is the change in the risk factors. And if we include this, we can see that actually the mapping from equation 1 can be written as the loss, the future loss, is given by minus the risk mapping in t plus 1 with zt plus the change in the risk factors minus the risk mapping of t and zt. And actually, this is trivial, this is trivial, this is known, this is known, this is known, this is our model. We need to come up with this. So actually it's our decision and our assumption. The only thing that is unknown is xt plus 1, which means that risk modeling and quantitative risk measurement and quantitative risk management more or less, in many cases, boils down to modeling changes in elementary risk factors. We need to model the future change in interest rates. We need to forecast the change in unemployment rates. We need to forecast the change in profitability, in dividend payments, and so on. And if we know these, all the other things and all the other variables are given. And this we can directly associate losses to changes in risk factors in the form of a function. And this is what we now refer to as a loss operator. If we apply this function to a set of risk factors, we get a loss. What does it mean? This function L of a given set of risk factor changes yields the associated financial loss. So, for example, we have a given set of changes in risk factors. If we insert it into the loss operator, the result is the financial loss in the future in L, in t plus 1. So the value of the loss operator for a given value of the random vector of risk factor changes corresponds exactly to the loss that the investor suffers with his investment due to the changes in the transition from t to t plus 1. It's just important for modeling purposes. Why? Because next we can assume that even if we have our risk mapping, we can do a small simplification. We can simply assume a linear approximation to the loss function or the loss operator. For example, we can take this function ft, zt, and we can try to come up with a linear approximation. And in fact, the linear approximation in this case is given by minus partial derivative of t with f with respect to t plus the sum of all the partial derivatives times xt plus 1. And this is, it's quite simple to do this. Simply take the function f and calculate the total differential. You will have to use all the partial derivatives, and you can see that this is in fact a linear function. It's a linearization of f and of the loss function, and you can see that it is now quite simple to estimate the losses if you have the partial derivatives of the pricing function f that depends on the risk factors. I'm only showing you this for one particular reason. Do you know one example in which case you actually have some partial derivatives at your disposal of a pricing function? And in which case you use this linearization and this linearized linear approximation of the loss function. This is a prime example in which you can apply the so-called Greeks from option pricing. We will see this later on. Option pricing, the most famous pricing model is the Black-Scholes-Merton model. The Black-Scholes-Merton model yields a pricing function for the price of a European, usually, or a European call option and other options. And in this modeling framework, you do know the partial derivatives of the price function with respect to the market parameters. And the market parameters are, of course, the basic elementary risk factors. And if you know these partial derivatives, you can simply calculate the losses arising from an option contract by using this linear approximation. So this is one application of the Greeks from option pricing. And down here you have the same with the linearized loss operator. Now, the advantage of using the linearized loss distribution is, of course, that it makes things much more simple. It makes things simpler, and you can try to calculate the losses in less time and with less effort. However, the quality of this approximation is higher if the changes in the risk factors are as small as possible, or if, ideally, the second derivative vanishes. So if the linear approximation is actually a good approximation, that is the case if the function is not very curved. But in case of the Black-Scholes-Merton model, of course, this is not the case. So actually, although one frequently uses the Greeks in a linear approximation to the losses from an option contract, this is actually also a very good example in which you should not use it, because the Black-Scholes-Merton pricing function is highly nonlinear. And a linear approximation will yield an approximation error that is actually quite high. Okay. Now, in general, we can distinguish between conditional and unconditional models. I've already talked about this. Every time you see a random variable x or L with no subscript, you know that this is an unconditional model. Every time you see xt or lt, you know that this is a conditional one, and it simply means that you are using a conditional model that incorporates information on the available information up until point t. Here you see you can fix the sigma algebra ft of the information available at the time t. In fact, it's a filtration, so the set of information becomes larger and larger as you move along time, and this conditional distribution is used for hopefully a more accurate modeling of a time-varying phenomenon. Now, in many cases in risk management, it is quite clear that you should use an unconditional or a conditional model. For example, in market risk modeling, in market risk management, you will almost always use a conditional one. Why? Because market prices change. Yeah, you have market prices for commodities, stocks, and bonds, and these prices change from day to day. So you will have to use a time-varying model. If, in contrast, you do credit risk management, actually credit risk models are usually unconditional. Why? Because the time period, the time horizon in credit risk modeling is usually 1 year or longer. And you only look at the probability that over the next year, a customer, another firm will default, and you don't need to reassess this default probably from day to day. So an unconditional model is quite sufficient. There is one exception in credit risk modeling in which you actually need conditional models, and that is credit derivatives. Why? Because now you're constructing securities and OTC, financial engineered securities, that have prices again that change from day to day, depending on a very accurate modeling of default probabilities. So when it comes to credit derivatives, you will have very sophisticated conditional models, whereas traditional models of default are unconditional. Okay. Now, obviously, because a conditional distribution is not equal to an unconditional one. Okay. And one example is a gauge model. We will see this later on, but if you've ever seen this in a lecture, in a class on time series econometrics, gauge models, those are time-varying and conditional models. Yeah? They even have it in their title. Gauge stands for Generalized Autoregressive Conditional Heteroscedasticity, and the conditional shows that it's time-varying. Okay. Now, when is it important on when it is necessary to use a conditional model? If you see this, and this is, I think, a return series of the German DAX index, you can immediately see that there are times in which you have high volatility and you have times in which you have low volatility. We call these volatility clusters. Periods of high volatility and periods of low volatility. And as soon as you see this, you know that any unconditional model that has a constant volatility is not accurate enough to model this type of time series behavior. If you see something like this, then you know this is a unconditional model. You know, this is unconditional distribution. It stays the same over time, but as soon as you see something like this behavior on this slide before, you know you need a conditional model. Okay. Now, the advantages of disadvantages of using a conditional distribution. The only disadvantage is, of course, it's more complicated. You need more data, you need more sophisticated models, you have higher model risk, you have a huge amount of different models, and you are increasing model risk by using a more sophisticated model. On the other hand, you have much more flexibility at your disposal, and you can model things that you before were not able to model with an unconditional distribution. So it depends on the application, but I would assume in market risk management you will always have to use a conditional model. Okay. Now, let me just quickly go through these slides. You will simply see some definitions and some formal definitions of these conditional distributions here. You can see, for example, that you're looking at the probability, the conditional probability that the losses tomorrow are lower or equal than a given value L, given the information set up until point T in time. Yeah? And I think I've talked enough about this, how this is done in practice. We'll later on see this. Okay. Now, also, this is interesting. If you ever hear or read something about dynamic risk management, it will almost always be related to a conditional distribution model. If you hear something about static risk management, it's an unconditional model. So in many cases, people and textbooks will not talk explicitly about conditional or time-varying modeling. They will just talk about dynamic models. Why dynamic? Because they are able to model the dynamic behavior of a return series over time. So if you ever see a dynamic model of credit derivatives prices, a dynamic model of default probabilities, you know it's a conditional model. No? Okay. Next, we want to look at a simple example for such a risk mapping. We consider a portfolio that consists of D stocks, in which lambda I denotes the number of stocks in the portfolio at time t. Stock prices are modeled under the process ST. From stock prices, we first derive the logarithmic prices as risk factors, so that we can use the log returns as changes in risk factors. In other words, in this very simplistic example, we are looking at prices for stocks, and what do we use as a risk factor? The changes in the prices, which is trivial, but again, in many cases, because you have so much historical data on stock prices, it's sufficient to simply use historical log returns as the single and sole risk factor for the price evolution, value evolution of this investment. We are not going into detail with profitability, liquidity, leverage, and so on. We simply use the log returns as the sole risk factor here. So xt plus 1 is the difference in the logarithmic prices, that is the log return. Okay. Now the value of the portfolio is given by Vt equals the sum of lambda I, the number of stocks in the portfolio, times exponential function of Zt, that is the weighted sum of the prices. Remember that if you insert the logarithmic price in the exponential function, you will get exponential function of the change in the risk factor, or no, not the change, but the actual risk factor. Then the loss is given by minus the sum, the weighted sum of St times exponential function of the change in the price, in the logarithmic price, minus 1. Do this at home, and hopefully you will see that the calculations are correct. I hope so. But at this point, it makes sense. The loss is actually the number of stocks times the initial stock price times the percentage change in the stock price. In a linear approximation, remember that we have this function for the linear loss approximation, which uses partial derivatives. In this case, it's quite simple. The partial derivative with respect to time vanishes, and the derivatives f with respect to the risk factors add up to Vt, and you have a weight Wt equal to lambda I times s divided by Vt. And you can see that the loss, the linearized loss, is given by minus Vt times the weighted sum of the log returns. Still makes sense? And the corresponding linearized loss operator is given below, also quite the same. And now let's assume we have a multivariate normal distribution for the risk factors, for the log returns, with mu and capital sigma as the vector of expected values and the variance covariance matrix. And you can see that with this linear structure, you can see that the expected value of the linearized loss is minus Vt times this weight vector transposed times the vector of expected values, and the variance covariance, actually the variance of the loss is given by Vt squared times the weight vector times the variance covariance matrix times the weighting vector. And this is the expected value and the variance of the loss distribution under the idea that you have a linear approximation of the losses, and you assume a multivariate d-dimensional normal distribution for your losses. Okay. Now what would you do with this? You would take historical data, you would estimate the expected mean of, say, these d different stocks. You would estimate the variances and covariances between those stocks, and then you would include them in this formula. And if you know the weights, you can simply calculate the expected mean and the expected value, and the standard deviation / variance of the losses. And in fact, with this linear structure, you know that the loss here will also be normally distributed. Very simple result. You know that if you take a number of normal distributed random variables and you have a linear function in these random variables, the resulting random variable will also be normally distributed. In German we say, dass die Normalverteilung unter linearen Operationen abgeschlossen ist. Ja, dass sie auch reproduzierbar ist in linearen Funktionen. So, if we assume a linear structure and if we assume a multivariate normal distribution for the risk factors, the result is not surprisingly a normally distributed loss, and the parameters, the expected value and the variance are given here. Actually quite simple. Of course, high model risk. Linear approximation is probably not accurate, and the normal distribution is not the best choice for the log returns of a stock portfolio. Next example, European call option. European call option, you probably know this, a European call option is the right but not the obligation to buy a certain number of underlying stocks, or the underlying, and the European call option on a non-dividend yielding share with current price S and a current maturity T and an exercise or strike price of K under the Black-Scholes-Merton model has the following price. The price is given CBS, Black-Scholes, is given by S, more precisely the current price or ST, times phi at D1, the value of the standard normal distribution function, minus K times E to the minus R times T minus S cap power times phi at D2, D1 and D2 are given below. And we have the following parameters. The risk-free rate R, the volatility of the underlying sigma, the maturity capital T, the current point in time S, that's trivial, it's actually not a parameter, and the strike K. So if you know these parameters, volatility, risk-free rate, strike, and maturity, insert it, and you get an arbitrage-free price for a European non-dividend paying call option under the model assumptions. And the most important model assumption is that the underlying follows a geometric Brownian motion. We will see this later on. We'll have a whole class just devoted to option pricing, and I will show you how you can come up with this model, because there is such a beauty to this model that is usually lost in a regular management class on option pricing. But at this point, it suffices to know that you can come up with such a pricing formula for an option. Now let's do this. Let's assume we have a portfolio of options. We are interested in daily losses. So we set delta to be 1 over 250. We assume 250 trading days. That's a good estimate. Yeah, we are not using 360 days, but we are using 250 trading days within a year. Now, in the Black-Scholes framework, interest rate, volatility assumed to be constant. Usually, this is a simplification. Volatility changes. We've seen this on the previous slide. Interest rates change. So we consider ZT to be the logarithmic price at time t, the interest rate r, and volatility sigma. Now, according to the Black-Scholes formula, the value of the call option on a day t is given by the pricing formula with t times delta, st, r, sigma, k, and t. And the changes in the risk factors are then, if we simplify it a little bit, those changes are given by the log return, the change in the interest rate, and the change in volatility. Obviously, the change in time is trivial. I know that from today until the day in 5 days, there is a lag of 5 days. So a change in t minus s is always known. It's not stochastic. Okay. So we know we need a change in interest rate, the change in the return, and the change and the change in volatility. Now next, we consider a linearized loss. That is, we are looking at minus partial derivative of c with respect to time s, with respect to stock price, with respect to the interest rate, and with respect to the volatility sigma. And those are known as the Greeks. In German also Griechen. The partial derivatives of the Black-Scholes and Merton pricing model have special names, and they are, for example, do you know them? How are they called? The last one's called the option Vega. It's options Vega. It's not a Greek letter, nevertheless it's considered to be Greek. The partial derivative with respect to the interest rate, R, is called the option Rho, and so on. I think, yeah, there on this slide, the option Vega, the option Rho, the option Theta, and the option Delta. And those are the Greeks. These are known analytically in this framework in the Black-Scholes Merton model. And you can simply use those and insert them, and then you can immediately calculate the loss that results from an option investment in case you assume the loss function, the risk mapping, to be linear. If you assume a linear approximation to this loss function. Okay. Now, how would you rate this approximation? I've already talked about this. In this case, you can do this, but again, the pricing function and the loss distribution is highly nonlinear. So if you use a linear approximation to a highly nonlinear risk mapping, you will get a high approximation error, thus high model risk. Okay. Now, next, let's assume we have a portfolio consisting of D risk-free zero coupon bonds with a maturity TI and prices P STI. The time is given in years, and again we denote by lambda I the number of bonds with a maturity of TI in this portfolio. Y from S to capital T is the yield to maturity of the zero coupon bond. So that is 1 over T minus S times the logarithmic price and with a negative sign. This is the yield of this zero bond. And again, remember that when you are dealing with bonds, prices are usually normalized to 1. So you would think that this pretty much looks like what? It looks like a discount factor. Actually, that's the case. It's the discount factor times a price of 1. And the price, the notional is normalized to 1. Then the following applies. The price should be the exponential function at minus t minus s times the yield to maturity. Okay. So, for example, a price of a bond would probably look like something like this. 0.95, 0.87, and you would know that you have a standardized payment of 1 at maturity. So with a positive interest rate, prices should be lower than 1 today. Okay. So we have these zero coupons. The mapping from the maturity to the yield to maturity is what we call the yield curve, or the interest rate structure or the term structure of interest rate. Zinsstruktur, and this is probably the correct term, the term structure of interest rates. What does it mean? You simply plot it. You have maturity T, and here you have the yield, and then you have three possible term structures. You know this. What is this? This is a flat yield curve, eine flache Zinsstruktur. This simply means that the yield is constant. This means that you have one interest rate R. In many cases, under normal condition, you have something like this. This is a normal yield curve, and this means that you have time-dependent interest rates, and interest rates increase with maturity, meaning that if you lend $1 for a year, you get 1%. If you lend it for a maturity with a maturity of 20 years, you will probably get not 1%, but you get 5%. So the higher the maturity, the higher the interest rate. This is a normal yield curve. And in very freak times, you might have something like this. You might have an inverse yield curve, meaning that the longer your investment horizon is and the higher the maturity is, the lower the interest rate is. But again, this is highly improbable and more or less result of a freak event in the economy. You usually have constant or very flat interest rate curves, or you have a normal yield curve. Okay. By the way, if you're interested in this, in the master's class computational finance at the very end, I show students how yield curves are approximated and estimated by central banks. And you can do this based on market data, but you can also go to R and use the package yield curve, and there you have market data from the European Central Bank, and you can easily highlight and plot the yield, the estimated yield curves in the European Union or in the Eurozone. You can see the estimations, for example, in 2006 and 2009 with some nowadays very high interest rates. You have interest rates back then of almost 4 or 5% when it comes to a maturity of 30 years. But you can see, again, even the difference between 2006 and 2009, you can see the difference in yield curves. No? Okay. This is a practical example from the Stuttgart Stock Exchange back, I would say maybe, I would say 4 or 5 years ago. Again, you can see yields, in German Rendite, yields that go up to 4%, and you can see the yields are quite low when it comes to a maturity of 1 or 2 or 3 years. They are even lower nowadays. With zero interest policy of the central bank, those yields have decreased additionally. Now we use the returns, Y, as risk factors for the bond portfolio. We are assuming, of course, that this portfolio is risk-free. Otherwise, we would need to use credit spreads as additional risk factors. We're using the returns, and the portfolio value is then given by V equal to the sum over all D bonds times lambda I times P. Expressed in terms of returns, this is Vt equals sum of lambda I times exponential function of this weighted yield. If we again linearize it and do a linear approximation, we get this linear loss minus the weighted sum of the prices times the yield times delta minus this change in this risk factor. And those are the changes in the risk factors. And it's quite interesting to now assume a flat yield curve, eine flache Zinsstrukturkurve. meaning that we assume y to be constant, so y is independent of maturity, and we simply assume that it can go up and down in parallel steps. So the change in the yield curve is simply given by ys plus delta. It can go up by delta, it can go down by delta, but it cannot change form, it cannot change shape. Then, in this case, look at the linearized loss. The linear loss is given by minus Vt times partial derivative of the yield times delta minus the sum lambda I, that is the number of bonds in the portfolio, times the price over the total value of this investment, times Ti, the maturity of this particular bond, minus T times delta, capital delta times delta. And this actually is the following: minus Vt times this partial derivative times delta minus d, and d is defined below. D is the sum of lambda I times P over Vt times this difference Ti minus T delta. One has to digest this a little bit for a second, and at some point you realize that you might have seen this before. You might have seen this in the Introduction to Finance. This is the so-called duration. It is actually the sum of all the payments of a bond weighted with the maturity of this particular cash flow. And this is called the duration of the bond. Is more or less the average payment date of all the remaining payments in time. And the duration describes the sensitivity of the portfolio value to a parallel shift in the interest rate. And in other words, it's the derivative of the value and the price of the bond with respect to changes in the interest rate, assuming the interest rate can only go up and go down in parallel shifts. And you can try to hedge your portfolio by trying to get a duration of 0. If you have a duration of 0, you know that actually your portfolio has no sensitivity to changes in interest rates. Then ideally, this portfolio would be hedged. Now, finally, let's change it a little bit. As you remember, a loan is more or less the same as a bond, just in a different legal setting with one additional ingredient. You have credit risk. And this means that if we take a portfolio of loans, we are looking at, say, agreements with M counterparties. The nominal value is referred to as EI. E stands for exposure. That is just the nominal value of the loan. For example, you've given out 20,000 euros, so EI is 20,000. It's your maximum risk exposure. Delta is set to 1. We assume that all loans will be repaid at T and that there are no early or partial repayments. Let YT be a random variable that takes the value 1 if the borrower has defaulted and the value 0 otherwise, which means Y is a default indicator. If it is 1, you're in default. If it's 0, you are in no default. So it's a discrete variable. For simplicity, we assume that the recovery rates the recovery rates of all credits are 0. Why? In many cases, you can still earn a certain amount of the exposure of the nominal value of your loan, even if the borrower has defaulted. How? There are numerous ways how you can recover your money. First of all, you send some people around, they start ringing the bell, and they might be able to recover some money. Second possibility is you go to a bankruptcy court, and you might recover some of the money from the remains of the company in the bankruptcy filing. in the law case, and so on. Or you might be able to sell the loan to a company that is specialized on recovering money from defaulted loans. Those are sometimes referred to as bad banks. That's the original idea behind a bad bank. A bad bank is a bank that buys up loans that have defaulted or close to default, and they buy up loans at a discount, and they try to recover the money. So a bad bank is not a bad bank, it's simply a specialized bank that has specialized on recovering money from defaulted loans. By the way, do you know one example of a bad bank? Usually one doesn't know about this. It's a very very generic name. If you ever hear the name Bank AG, BAG, it's located, I think, in Hamm, very close to my hometown. The Bank AG is, do you know it? It's the bad bank for all cooperative banks in Germany. It's the bad bank for the Genossenschafts- und Raiffeisenbanken, genossenschaftlichen Sektor. So it's the bad banks of all cooperative banks in Germany, and they tend to sell off their bad loans to the Bank AG, and it is specialized on recovering money from those loans. We assume here recovery rates are 0. So if someone defaults, everything is lost. Makes things much easier. We start with the evaluation of the loan's cash flow. Since the loan is exposed to default risk, we have to discount the cash flow, EI, with a risk-adjusted interest rate. More specifically, we use the risk-free interest rate, which is the yield on a risk-free zero coupon bond with the appropriate maturity, plus a risk adjustment, plus a risk premium, because we need the risk-free interest rate plus the credit spread. So the VT is given by exponential function of minus t, capital T minus t, times the yield plus the credit spread CI times the exposure EI. And CI is the individual credit spread. So we have a credit risk that can change from loan 1 to loan 2 to loan 3 and so on. How do you estimate credit spreads? The simplest way is simply to go to Bloomberg, extract some credit spreads from bonds, and use credit ratings and so on, and you can simply take market data or data from market specialists to come up with an estimate of the credit spread. Now we simplify this model. We assume that the credit spread is actually the same for all borrowers. It's not CI, but it's equal to C for all borrowers. And in summary, we get the following value of the credit portfolio. VT is equal to the sum over I of 1 minus y times exponential function minus capital T minus t times y plus c plus EI. Now here, I want to write this a little bit more simple, a little simpler, with not a continuous discounting, but with discrete interest rates. Now assume you have an exposure I, EI, and here we write this is 100 euros. What is the value of this? We need to discount this by today's interest rate. So we would simply write times 1 plus R. Now R is the risk-free interest rate, so we need to add CI. So let's assume 1 plus 2% plus 3%. So we have, and with continuous discounting, we have this, and this, and this. Now remember, we need the maturity, so we have T minus T. Let's assume we have a 4-year loan, and this is how this difference between capital T and T enters this. It's simply included in the exponential function because with discrete interest rates, we would have 1 over 1 plus r to the tth power, or capital T minus tth power. So this is clear now. And we have M loans. So we have to add up all the values of the M loans. The only thing that is unclear right now is why we have to include 1 minus y. And why is that? In case the ith loan has defaulted, we will get nothing. Recovery rate is 0. So if we have a default, we will have y equal to 1. And then there will be 1 minus 1, that is 0 times value of 0. But if the loan is not in default, we will have a 0. So there is 1 minus 0 equal to 1 times Vt, and this will be larger than 0. So 1 minus the default indicator simply distinguishes the two cases of default versus no default. And then we can see the risk factors can be summarized by the default indicators y1 to ym, the risk-free rate or the yield, and the credit spread. So we have m plus 2 risk factors, and the loss lt plus 1 can simply be calculated from this. We use estimates for the credit spread, the interest rate, and the default probabilities. Because yi, these default indicators are nothing but default probabilities. So this credit risk management and credit risk measurement simply comes down to forecasting the risk-free rate, the credit spread, and the default probabilities. If we include this, we can come up with a very simplified model of credit risk, but we could estimate the loss that arises from this investment in M risky loans. And those are not risk-free, but risky. And we need the default probabilities and the credit spreads. Okay. By the way, last question for today. Why do you need the credit spreads and the default probabilities at the same time? Because they do contain the same information, right? The credit spreads reflect the credit default probabilities. But why do you need default probabilities and the credit spreads? Yeah?
In this example, we just have either a complete default or a complete non-default, and thus the credit spread reflects kind of the probability of the customer defaulting, because if the probability of a customer defaulting is higher, you would have to discount with like 25%, for example, and if it is lower but not incorporated in the dummy variable, then it would be the 15% discount.
Now, slightly correct answer. You need to remember that actually credit spreads do reflect default probabilities, and they, of course, they go in the same direction. The higher the default probability, the higher the credit spread. But the companies actually implicitly set the credit spread here. Why? Because, of course, the company is earning a certain interest rate. And for example, if the company has set a 5% interest rate and is using a 5% interest rate for its own internal calculation, but the credit spread is actually quite higher, then of course the loss should also be higher, the potential loss and the potential value of this investment is lower. So here, it's not a given that actually these match. You're using market data and a market or a theoretical assumption on your credit spread. And if you, for example, realize that the credit spread is actually quite high. Then of course, let me start again. If the default probability is higher, the company should expect and should ask for a higher credit spread. But this is not a given. I mean, you would estimate the default probabilities, but it's a totally different question whether the bank, for example, is able to ask its customers for such a high interest rate, and if customers are willing to pay such a high interest rate. So credit and credit risk and default probabilities are one thing. The interest rate the banks ask from its customers is the other question. Of course, they will try to use credit risk and their assessment of credit risk to set the credit spread. But it might be higher, it might be lower. So the information on credit risk is not necessarily fully reflected in default probabilities. Okay, so you have to model both. Credit spreads, that is the interest rate the company has asked for as a risk premium, and the actual default probabilities. Okay. Do you have any questions concerning risk mappings, risk factors? Please remember that usually you don't directly model losses, but you do model elementary basic risk factors. And those are always the same. Default probabilities, market returns, interest rates, market fundamentals like, for example, unemployment rate, GDP growth rates, and so on. Then you need to come up with a risk mapping that is a function of the risk factors that yields the loss and the value of a position. And then you need to find a good model, a good risk mapping. You might have to linearize it, and then you simply have to identify the appropriate risk factors, and then more or less you're done. You need to know that it is important to look at changes in risk factors, and quantitative risk management is just modeling changes in risk factors with statistical models. It's highly complicated and not as simple as it sounds, but theoretically it's just about finding a proper model for the changes in risk factors. Okay, if you have no further questions, we'll stop here and I'll see you next week. Thank you.